great honor to host the panel with two great guys from the markets. First of all, our guest from Poland, Mr. Piotr Polanowski, who is a member of the board of the Polish CFA Society and also member of the supervisory board of the FinTech MP and an M&A consultant for, how was it, more than 30 years now? Piotr? 25, okay. And my other guest here for this panel is Mr. Elvin Guri. I have had the pleasure to know him for some 10 years now. He is a managing partner here in INVENIO Partners. So we will try to do something a bit more different. We'll try to touch the topic, but we'll try to make it conversation-wise, so that every one of you that wants to ask something or just wants to raise a topic during the conversation, please, you're welcome to do it, even if you want to interrupt us with something. Yeah, and just one more topic. As it often happens in private equity deals, we had an investor in this time, a panelist, budging out, so Mr. Pavel Velkov will not be able to attend this panel, but we will try to cover her for him. So guys, today's conference, it started with geopolitics, the global picture, it moved through public markets, and then it comes to us. So shall we try to circle it around and go back and just give a brief overview about what the current macro and geopolitical situation does to private markets, to private equity markets, and to the business. We've discussed that the volume of the deals is a bit down, but what are your visions? How does the whole world mess affect your markets, and what's the future?
Thank you, Nikolay, for the introduction and giving some foresight to what I plan to talk about. Rightly so, you said that a lot has been discussed about politics and macroeconomics. We had an excellent panel here on public capital markets, and so we're going a bit downstream, or otherwise upstream. I had the pleasure of speaking here around 2019, exactly, at this very conference in a very similar panel about M&A transactions in general. And from our perspective and the topic today, private equity and venture capital, the key benchmark is the value of M&A transactions. So the night before my flight, I started scratching my head, and I remembered that I think I still have the notebook with the notes that I prepared for a very similar panel 9 years ago. And I'm like, okay, let me take a look at it, and I started reading, and I'm like, okay, market size 2017, 70 billion euro. Okay, that sounds quite impressive. At the time, this was mostly strategic transactions. There were a couple large transactions, or otherwise transactions that seemed large at the time. That included Allegro. That was when CVC invested in Allegro. We'll talk about that a bit later. There was also the Żabka investment, which took place around 2017-18. And then I researched, okay, what's the size of the market today? 40 billion euro. Something's wrong. What happened? You know, it was 70 billion in 2018-19, and now it's only 40 billion. The truth of the matter is that M&A markets are very cyclical. They react to a number of different factors. 2021, I think, equaled this maximum that we looked at in 2017. And but since we're sort of in a correction and a maturation phase, Now, the fact that markets or the total M&A transaction values did not increase is not bad in itself. Okay, you have to look at also the quality of transactions, their numbers, and how they impact the economy in general. So from that perspective, we have what we have. I also talked about something that we discussed earlier on during lunch today, about what could be happening in this market. And I sort of expected that we would have more and more private capital from successful entrepreneurs that have managed to cash out from their businesses and then reinvest in the market. And I think today we are seeing this, that this capital of successful investors or entrepreneurs from the 90s and the early 2000s is coming back into the market, among others, through private wealth or through investment funds that include private equity as well as public capital market investment funds. So that's a bit from my perspective. I'd like to develop on these two transactions because they are in fact model transactions from today's perspective, but we'll do that later on.
Yes, Piotr, thank you. We'll come back with the successful examples later. Elvin, would you share us your perspective on what's driving markets and how are they being driven?
Our region, even if you include large countries like and developed countries like Poland and Central Europe, is typically in the receiving end of geopolitical developments. Thankfully, so in a sense, we tend to suffer the consequences of what happens in other places, and those consequences can be both good and bad. What we're seeing today is that the price of assets, private assets, across the board is decreasing, which makes it a bit more attractive to acquire companies or to invest in companies. But on the negative side, fundraising has become a lot more challenging. Historically, it has been challenging, especially for smaller players like us that seek to go out of their region to seek to compete regionally or in the Balkans or in Central Eastern Europe. But today it has become that much more difficult. There's another positive effect that Piotr hinted to, and that is that private capital, which I would generally include in private equity, not simply those organized players such as fund managers like us, private capital in the region is becoming a lot more regional. We're seeing a lot more players that are coming out of their comfort zone and of their local markets and investing across the board. This includes both private equity funds, such as the older ones, Mid Europas or Enterprise Investors or Innova Capital and so on, but also and crucially private players, whether it is Penta Investments or EMA Capital from respectively Slovakia and Czech Republic, or 4IG and a few other Hungarian-based players, or increasingly also players from our region, Romania, Bulgaria, Serbia, that are seeking to become a lot more regional. That, I think, is a very encouraging development. The existence of people like us, fund managers coming from the small countries, is also sort of our investment thesis is that we help such investors that wish to become a lot more regional to develop these regional capabilities and to become more competitive. The fact that we are already seeing players that have the sophistication and the capabilities to come out of their own countries is very, very encouraging.
Yeah, the regionalization of the business is a trend that's been obvious, especially here in the CEE or even in the more eastern part of the CEE region recently, and that's something visible. Before moving to the other topic, just a quick touchdown. Piotr, you said that the business was at 70 billion, now it's at 40 in terms of deal size, right? And the turning point seems to be 21, the COVID, the war in Ukraine, so inflation and interest rates. What is the impact of these different interest rates environment that we are in? Because the decade before 2021, it was easy, a lot of free money, a lot of money seeking a source of some return, if not any. Now things are different, so what is the effect? We globally know the effect, but what's the regional effect of the changes in interest rates and its drive on the private equity markets?
Well, as we discussed, markets, including private equity markets and interesting markets, they're cyclical. And usually apart from regime changes, you can, it's difficult to look at individual statistics year by year, because you always have some unusual large transactions or lack thereof. But as a rule, falling interest should have increased total transaction value, not only because of the increased availability of financing, but also because they impact directly valuations. Yes, so even from that perspective, such an environment should be conducive to increased investor activity. Nevertheless, whenever we look at the impact of one particular element on the market as a whole, it's very difficult to identify ceteris paribus, because you have a number of different variables impacting at the same time. And so when we initially discussed to maybe move over the question of geopolitics and events in the Middle East and other previous events like COVID and geopolitics in general, is that I see that we're moving from a new normal to a new normal to a new normal, and capital markets seem to be very resilient in this regard, regardless of what unexpected and unusual events we encounter along the way.
I think it's also a reflection of the relative underdevelopment or lack of sophistication of our markets. You don't get listings such as Allegros or Impost or Żabka or Hidroelectrica every day. Just like you don't get a UiPath or an InfoBip or a Rimac or a Payhawk every day. And these tend to influence or tend to skew the results for the region and for particular markets. One year the value of the transactions is up, another year is down because you don't get a unicorn that year.
That's a normal outcome, I would say. And just to share a quick touch on my opinion on that one, I think the private equity markets were somewhat resilient to the interest rates environment. And actually this moves us to the second topic, and it's I would like to touch down on the importance of the private equity and the venture capital industry for our economies, for our route to innovation. We've seen a lot of innovation here in Bulgaria going through venture capitals, through the government-sponsored programs, through the fund of funds. And I think the importance of the sector as a whole has improved. And thus, we have, together, the three of us, we have formatted this statement that the private equity should go out of being just considered as an alternative investment source, but moreover as a tool for progress. So, would you share my opinion that private equity and the venture capital and the whole industry has tremendously increased its importance for economies and for the prospect of growth of the European Union as a whole?
I mean, focusing still more on the CEE, because we're looking, when we take into account the whole European Union, we have to discern these really emerged markets that are, on the one hand, much more competitive. On the other hand, their sources of financing are completely different from institutional financing, like pension funds, through the whole ecosystem. But I mean, to state, I guess, a blinding glimpse of the obvious, venture capital and private equity, be it in the CEE region or generally in Europe or globally, bridges the equity gap. You know? And it also helps bridge a certain valuation gap in that smaller businesses that perhaps have significant perspectives but also are very hungry for equity and, well, initially equity financing. They are well, targets, yeah, but at the same time opportunities for venture capital and subsequently private equity as small and medium enterprises, where they fit into a strategy where, on the other hand, the investors try to find opportunities that they can acquire for 3, 5, 7 times EBITDA or prospective EBITDA, and then build a platform, consolidate across regions, develop certain niches, scale. Typical example are marketplaces like what we mentioned, Allegro, where they consolidate and then are able to exit either through what we usually saw were trade sales, or more recently this has come back, public listings, or sales onto larger global funds at a premium. Yes, after having built value both on just the EBITDA, plus the scale, plus the dynamics and market penetration. And of course, you know, they are also commercial entities there to make a profit. Yes, you're moving from valuations of 7 to maybe 10, 12 based on historical perspective EBITDAs, and it's a reasonable market model that positively impacts the economy as a whole.
Is the industry as important as we would like to be? No. We're still very young. The players and the industry itself is immature, and as a result we cannot play the role that we could be playing and should be playing in the economy as a whole. Having said that, and by that I mean that the Bulgarian private equity venture capital ecosystem is barely 12 or 13 years old. We still haven't suffered a crisis of identity. We are still in the process of maturing as an industry and as investors, which means that in the case of venture capital, we cannot play the role of consistently supporting startup companies, especially in the technology sector, to seed their ideas, help them grow their ideas, and eventually expand. We cannot do that on a consistent basis. On the private equity side, which I see mostly as a vehicle for transferring managerial skills, strategic thinking, capabilities to manage operations and finance, the demand is there, but the sophistication of the market is not there. Not just the sophistication of players such as ourselves. As a result, we cannot play the role that we're supposed to be playing properly. To put it differently, if someone were to give me €1 billion to invest today in the markets of the region, I wouldn't know what to do with it. I don't think that there are a sufficiently large number of prospective companies to apply the strategies that we can do in this market. We are an increasingly important part of the economic fabric of our societies. For the past 5 years, the Bulgarian ecosystem has invested in upwards of 500 companies, and it has helped mobilize more than 1.2 billion euros of capital, of equity capital in Bulgarian companies. You put that against the background of the GDP of the country, it's still peanuts. So in other words, banks continue to be the main source of funding. We are getting there insofar as our impact and influence and in the ecosystem and in the economy.
Interestingly enough, you've mentioned the investors there, so of course we know that to have a deal we have to have an investor and an investee, and that's far away from CFA level 1 even. But anyway, let's touch down on the investors' composition, and I would like to make it a compare and contrast session here between Bulgaria and Poland from your experience. We know Bulgaria is basically private investors, family offices to some part, but the large institutions are not there. There was just a recent change in the pension codex, which will allow the pension funds to at least allocate some normal portion of their portfolios to private equity, when this is very recent and we haven't seen its effect materializing yet. Anyway, compare and contrast, what's the major investor compositions here in Bulgaria and in Poland in terms of the major players in the market?
Nikolay, you touched a couple of elements. I'm wondering where to begin. Maybe from a top-down perspective. Yes. Today we're still, and I think it goes for the whole CEE. We're still developing an ecosystem of domestically financed and domestically managed funds that are able to do larger transactions. This is happening in the middle and medium market, euphemistically putting it, but the larger transactions are dominated by large internationally funded funds. I would like to touch upon the topic of pension funds in general, but today, be it Poland or Bulgaria, we don't see activity of pension funds in the alternative investment market practically at all, regardless of the size of assets under management. There are reasons for this, yes, that include, for example, Poland was supposed to set an example in terms of construction of pension system based on 3 tiers, where the private sector or otherwise investment management firms played an important role. And then in 2015 we demolished it, to the surprise of everybody who is still trying to implement or has implemented it. This did result in perhaps, first of all, loss of trust for the asset managers themselves, and what remained really just focused on more liquid assets, listed, marked to market, making valuations of the funds simple, decreasing risk. I believe in Poland, in fact, the exposure of a pension fund is limited to 5% or something of assets that can be invested in alternative investments. But I don't think it even reaches 1, quite frankly. It's just not happening, which is very sad, and I think it's something that can actually be improved upon very easily, but you need the ecosystem of the local funds, not only international funds that are actually present and active in the market. And you also need to have targets, yes. So companies that are actually investable, and this is happening. Yes, we are arriving at having unicorns appear in our domestic market. Yes, with valuations of over 1 billion. This doesn't happen very often. But the second class of investors that has appeared in the regional private equity market is public funded funds. And again, Poland is trying, I guess, or has built an example in this area. I've been observing this process since 2008. You probably have heard of this since 2015 with something called PFR Ventures. It's PFR Venture Capital. It's a sub-fund of the Polish Development Fund, an entity established around 2000 to 2015. Before that, there was something that was actually called the National Capital Fund, KFK, which was the same model, co-funding of funds by the state at, how to say, preferential terms. So the private investor received his returns before the public investor, so you could sort of lower your downside risk and things like that. And the KFK, this was not, this is, how to say it wasn't recognized, but in fact, PFR Ventures was the one that appears to have made it. And frankly speaking, at the beginning when this was launched, I was very skeptical. I expected, first of all, due to the lack of targets and companies that were investable at the time, I expected excess competition and essentially crowding out of private capital that did not want to be funded by public capital, yes, just for flexibility and the lack of restrictions on investment policies, actually having somebody from a government-funded institution overlooking the work of your investment committee. A lot of people don't want that, and a lot of people work privately. Nevertheless, the competition increased. Also, I looked at it from the perspective of costs. I actually prepared an analysis. What is the break-even to successfully manage a small fund and not go like, how to say, to cover costs, in short. And I calculated that from the fund manager's perspective, irrespective of the returns and the profitability of the investments and their carry at the end, the minimum value of such a fund had to be at least 20 million euros. Otherwise, from the management fee, the measly 2%, yes, you're unable to cover the work of your management, the analytical team, the origination, analysis, and transaction execution process. So that was the case. Nevertheless, PFR Ventures began a number of programs, and I think this is a model worth replicating in other jurisdictions, where they co-funded a number of funds in different phases, or otherwise with different mandates. First and foremost, they co-funded seed and angel funds. Another interesting one was corporate venture capital funds. And there was a moment in time where all of a sudden the major corporate players, especially the state-owned ones, I don't know, PK and Orla and things like that, were establishing CVC funds and looking for teams and things like that to actually manage these. And there was actually a deficit of teams and people willing to do this at one point in time because there was demand, there was apparently funding. And also the third area was deep tech in general, so funds that were focused on deep tech. I think the metrics and the history on this is quite interesting because in 2015, I think the capital commitments the first year this was really in operation were about 40 million euros in that year. Today, it's around 800 million, which is practically 20 times growth. And about this process of filtering out funds that actually survive. I think in the past 10 years there have been over 150 active investors that were engaged in over 180 transactions. Of these, only about 35 have continued to operate. Yeah, so 115 or 115 just discontinued operation after the first round of funding. Nevertheless, these 35 funds that actually survived and created a team, gave their investors back their money, in short, and maybe made some profit on it. I think that was returning the initial commitments after 5 years of investment is also a success from some perspectives. Nevertheless, these 35 funds funded 166 companies just in 2025. So for sure, as skeptical as I was towards these initiatives in the beginning, it seems that they matured, and especially over the past 10 years, they have successfully created an ecosystem of domestic funds that are now doing roadshows and the second, third, fourth round financings from commercial investors internationally, and really increasing the number of transactions that are financed by such domestically developed and raised funds. So yeah, I think I'll let you continue on that one.
I see 4 types of investors for our industry. You have first the supranational organizations, the European Investment Fund, the European Bank for Reconstruction and Development, International Finance Corporation, and the like. The European Investment Fund is, for our region, it's basically our sugar daddy. Their involvement has been existential for the creation and the continued existence of this industry. Increasingly, especially in times of difficulty like today, the role of people like EBRD and IFC is also becoming existential, not simply good to have. Without them, there simply would be no fund managers existing today in countries like Bulgaria and Romania. The second tier of players is the one that Piotr described earlier, which is state-owned players, like the Fund of Funds in Poland or the FNFIP here, and so on. These players, their existence is a bit like socialism. In theory, it's a good idea. In practice, yeah, not so much. Partially because they suffer on the cost side. It took the FNFIP here 2 or 3 years to ramp up and to choose a fund manager and so on, and in the meantime, they spent probably 40 or 60 million euros on salaries and ancillary services. Longer term, though, the existence of such institutions, I think, is vital for conducting national policy and for channeling resources in those areas where it is important for the country to develop, where there are certain priorities, national priorities. So we need to get our act together and do better when it comes to such national organizations. And the fact of the matter is that FNFIP here has become progressively better in channeling funds, especially when it comes to the technology area. The third tier is the pension funds and asset managers. Lest we think that the problem is only ours here in the region, it is a Europe-wide problem. Pension funds are simply not as active in financing the industry, especially compared to UK and to US. The industry likes to think that this is one of the reasons why we do not get to channel as much money as the Americans do to technology, innovation, and so on and so forth. It is correct. In our case here in Bulgaria and Romania, I feel it's less to do with the legislation and more to do with the regulatory aspect. For instance, and even so, there are workarounds and there are solutions that can be done, even in a perfect regulatory framework. And it takes a bit of willingness, as was the case when Dina and KBC decided to support our second fund. The regulatory framework was not exactly clear, but all of us engaged very constructively with the regulator, and we managed to find a solution, even before the current legislation was passed. So there are ways and means that one can do that. Finally, I think there's a fourth player, and that is family offices and high net worth individuals. In larger countries, more developed economies like Poland, they are a very important player in the private equity and venture capital space. But not only there, you have the case of Romania, for instance, where Julian Stancu of the EMAC fame single-handedly almost has invested in 3 or 4 funds. And on top of it is supporting financially also the Romanian Private Equity Association to spread the message around. Smaller economies like ours tend to suffer from size. Even so, most of the players that I'm aware of, and we are 20-odd fund managers in the country, have managed to secure significant amounts of money, of private capital, both in their funds and also in the co-investment space. As I mentioned earlier, out of those 1.2 billion that the industry managed to catalyze, only 600 million came from the European Investment Fund. The rest came from private sources. That is not an insignificant achievement in a small but growing economy.
Indeed, and yeah, if I may add one thing here is that we have seen a pickup in private investors in the area. And one of the reasons behind this is, especially for Bulgaria, the fact that we have managed to build enough in terms of number and wealth private investors that can go into the deals. We touched bases on a topic that's interesting, and it's about the origination of deals. So, speaking about family offices and private investors, obviously in Bulgaria, as is the case in Poland as well, we have this private economy for like 36, 37 years now, since the fall of communism. And I'm really interested into knowing your opinion on that one, but do you expect maybe a pickup in the deals on the sales side because of, people that have created successful businesses in the 90s, getting of age, maybe wanting an exit of their business? And do you expect to see such kind of a pickup in origination, especially in mid-segment or larger deals?
Nikolay, I think, you touched upon one of the sources of origination of deals, and that is these are successions, yes, of successful private entrepreneurs that want to reach out and seek exits, yes. Rarely are these exits that are large enough for public capital markets. More likely these are either institutional investors in the form of, for example, private equity funds, or strategic investors. Historically, we've seen that there were many more trade sales than there were private equity investments. I think this is changing, yes. Strategic investors are still at the end of the investment cycle and ultimately buying successful businesses or investing in successful businesses in their industry. But along the way, you do have the financial investors. I think what is important, and I represent the advisor side. I work an advisor both on the buy side But from a practical perspective, even more on the sell side, and I feel comfortable on the sell side. I observe this market, I actively participate in it. And something that I wanted to share with you is that the traditional private M&A sell-side transaction is changing. Okay, in the past, auditors, big four consulting firms, and their competition in the form of smaller corporate finance boutiques, but primarily the big four, they perform so-called transaction processes with a long list of investors where they prepare materials, send it to everybody they could possibly send it to, and sometimes we're successfully able to sell a business. This model has ended. It doesn't work. It doesn't work, and I find that in many cases such processes end in failure. Why? Is because the role of the intermediary or the financial advisor in such a particular situation has also changed. Frankly speaking, today we have the whole AI situation where the quantitative work, even in some cases preparation of these investor lists, of the information memoranda, teasers, mailing lists, whatever, probably you could even automate the sending process.
About the AI there.
Yeah.
It helps out, doesn't it?
But what you cannot automate is the HI, the network of contacts, the ability to identify investors, to actually speak to the human behind the AI at the other end, regardless if it's the investor or the company seeking to perform a sell-side transaction or a financing transaction. And so, frankly speaking, from my perspective, perhaps AI has actually changed the quantitative and the analytical process, yes, but it hasn't changed the decision process. I mean, it's difficult for me to imagine a purely AI fund that actually makes the decisions and actually holds the negotiations and actually tries to manage the human element of the human emotions. And I found that increasingly in transactions, the advisor almost becomes like a corporate psychologist. Okay, the numbers are there, the figures are there, but what do you make of them? Yeah, and are you sure that your expectations that are quite high usually, yes, that is especially in terms of these family-owned businesses where the prospect of succession is a once-in-a-lifetime deal, the expectations are usually completely out of the market as well. Nevertheless, in certain scenarios where you focus on 5, 6 particular investors that have significant merger synergies, where there's a business model, for example, for a private equity fund that can indeed platform this business with a bunch of others, create a regional presence, then this actually does work.
Elvin, what about the structure here in Bulgaria, the origination? Do you see a change here? And what Piotr said about the level of local advisors, third tiers, except for the big four, I think I would put a bit of a plus here to our society, to the CFA charter as well. We've seen many professionals following the way and becoming M&A advisors. So what are the changes in origination?
First, let me try to give my 2 cents on the succession issue. You'll find the succession issue as an investment theme in the prospecti of virtually all fund managers in private equity in our region. All of us. Because it's such an obvious thing. In practical terms, though, very few of us manage to do it well. Innova Capital have built their whole business model around succession and partnering with entrepreneurs. The rest of us have more mixed results, so to speak. On the advisory side, I think the development of the market follows the development of the whole economy. So, while in Poland and other larger markets you will find local boutiques that tend to compete successfully with more established practices of the Big Four, for instance, not to speak of the bulge bracket and the large investment banks. In the smaller markets, you'll find that the Big Four are more dominant, first, and second, they've had more time to review what other markets are doing and seek to adapt. Case in point, family businesses and succession issues. Advisors have realized that you need to shepherd companies, founders and owners, so that they start appreciating the intricacies of the succession process and start planning ahead of time. Just because the need is there does not mean that the need is recognized. I have dealt with founders, 85-year-old, who think they're going to live forever. I've been in transactions when on the other side there was a paralyzed guy that was communicating only through one eye, and he took all the decisions. So in such cases, the presence of advisors, long-term advisors to the family, helps quite a bit. For instance, Ernst & Young have built a whole practice with family networks and family businesses. They have been pioneers in this country when it comes to it. I hope that helps to address.
It was very insightful, and thank you both for that one. Another topic of interest might come in the development of the private debt industries. So we've seen private equity going through its, I would agree with you, Elvin, when you said that we are still in the late infant stage of the development, but private debt industries have just originated throughout the region, haven't they? What are their roles, and what's the future ahead of them?
I must say, apart from private equity, I am actually a fan of private debt and private debt funds as a business model. That perhaps it's a question of perspective, but in fact they are a part of the same ecosystem. And private debt, much like corporate bonds, they provide financing in special situations where we have had, and probably historically we have a market where banks have dominated, very much in this German model. Yes, 70% of financing from banks, the remainder from other directions, much like the US model, where essentially corporate bonds have provided for the elasticity and the success ultimately of the market as a whole. Because it's not a 0-1 decision, yes, just based on a number of ratios. With corporate bonds and conversely private debt, it's a matter of price. Yes, so the more risk, the more expensive it gets, and private debt funds actually make a calculated risk of default, of non-performance, of having to roll over this debt, and they put a price on it, yeah? And we were sort of discussing with my colleagues here earlier, okay, if the benchmark returns, expected returns of a private equity fund are 25 to 30, then perhaps a private debt fund would expect 10. I would disagree with this. I think the expected returns of a private debt fund can be as high as private equity, yeah, if positioned correctly. And at the same time, at that very price, it could be quite affordable and useful for the beneficiary, or in this case, the company procuring this financing. I like this example of a typical private debt transaction where, for example, you have a mezzanine fund. There's a residential real estate developer, yes, or an office real estate developer, or a logistics real estate developer. They're realistically able to obtain 70% leverage, no more from a bank. It just doesn't happen. And if you're able to procure, that leaves you with a 30% equity exposure. If you're able to procure another 15%, so half of your equity from some sort of secured subordinated debt from a mezzanine fund, subject to the effective weighted average cost of capital, you can probably double your portfolio, your development portfolio, yes, and then therefore significantly increase your return on investment over a shorter period of time. So I think private debt is a very competitive segment of the market. And it also works very well with private equity because it allows for more flexibility both for the company and the fund, and essentially can also be used in M&A financing. And I expect expansion of this segment as a M&A and growth developer for the growth enabler, for the market as a whole.
As you know, I was born and raised in Albania, which I left in the early 90s. At the time, we used to have a joke, if you'll indulge me for a bit. The end of the world is coming in a week, so the whole world is panicking and there's chaos everywhere, people rushing to do the last things before everything ends. With the exception of Albania, where life goes on as usual. And when they're asked, don't you know that in a week everything ends? The answer is, we're 100 years behind. So, I'm sharing this joke because part of the reason why we don't see so much non-bank lending in the country is that in the Western markets and in the more developed markets, it appeared when the banking sector started hitting limits, whether regulatory or they started getting far too dangerous, and the regulators came down hard on them. When there was too much lending, in other words. We have never had that luxury in our part of the region, right? We've never had too much lending, and so generally we found ways to make do and to work with banks that have become increasingly more sophisticated to finance our activities. Having said that, and as Piotr mentioned, there is quite some space when it comes to mezzanine specifically to do more in all of these countries. With a bit better structuring, more education of the market and of the players, and better cooperation with people like us. However, that suffers from, first of all, small size of the countries. You cannot very well have a mezzanine fund or a credit fund only for Bulgaria, for instance, or even only for Romania. And second, you'll find that you struggle to find investors outside the international financial institutions like the IF, EBRD, IFC, and so on, because the others need to be educated on the fact that you can actually extract equity returns from well-structured debt funds. That will take some time until we get there. I can't wait, because for people like us, this is, you work much more easily with such funds, you speak the same language, than with banks, but I think we're a good 7 to 10 years away.
I would support on this one pretty much, and I think a good vessel for that one would be the development of the mezzanine funds, really, but they need to be well supported in terms of capital, and yeah, we are not there yet, but I really hope that we see it, because it will really help companies bridge the gap between, you know, the startup phase and the real working small medium range phase. So
I think we'll sooner see infrastructure funds in the region than credit funds. The need is very identifiable, it is there, and that need has also been recognized both by international players and increasingly by the government.
Indeed, when you speak about infrastructure, you run into the other kind of problem there. Basically, you need government support there. You need support to have a highway, paved or tolled or whatever. So, I don't know, Piotr, what was the case in Poland, but here in Bulgaria we don't have enough support for having such infrastructure and private equity funds. In Poland, do you have that?
There are funds like the Amber funds that are international projects that help fund infrastructure. The question that you have to consider is where is the line between the public sector and the private sector? Yes, so I think that what I would like to see the most is expansion of these private-public partnerships where you have you have the presence of both the public sector and is also providing concessions and things like that, and private entities actually funding it. But I mean, taking into account the scale of such projects, I think it's a whole other discussion. Yes, where to procure such funds in the first place.
Thanks for that one. So we're nearing the end of our discussion. I wanted to ask you one question, but I know that people tend to view their own deals or their own participations as the great successes. But put that aside and just tell me one ethanol from your local markets in terms of private equity deals, but ethanol not in terms of, okay, we need this and this return on the money, but ethanol in terms of impact of the company.
Yeah, that's an interesting question, and I was considering it, and I think I'll just cross-reference back to my notes from 2017, where I mentioned two transactions. That was, on the one hand, Allegro, and on the other hand, Żabka. And what happened to them from 2017? Look, both are close to my heart. I'm an everyday user of Allegro up until today, and I actually take walks to the Żabka after 10 o'clock because now there's an alcohol curfew at 10 o'clock, so the Żabka is empty. After 10, there's nobody there, even on a Saturday night. So it's the best time to catch some fresh air and to buy your milk for the morning coffee. But look, both of these transactions, Allegro was IPO'd 2020 for I think something around 12 billion, so they made 4 times their money in wow, only 3 years if you think about it, 3-4 years. Żabka is a similar case. It was IPO'd in 2024, also 4 times money. So if these were transactions that I would like to have been involved in or otherwise invested in 2017, these would have been 2 of my favorites.
Thank you, Piotr. Elvin?
I don't have any examples from my personal practice because I've been more lucky than good, but
I tend to disagree with you on that one.
I'd say that a very recent example from the Bulgarian practice is Black Peak's investment in EU shipments. They invested when the company was small and it was purely Bulgarian. They helped them grow, both the organization, but also effect 3 or 4 acquisitions. And they sold to a strategic investor very successfully. It's the stuff of, the rest of us. This is exactly what we dream about, because we want all of us to help good Bulgarian companies to become large regional players.
Indeed.
And they put it in practice.
Indeed. Okay, guys, we're moving towards the end of our discussion. Hopefully we can take 5 minutes for questions. I really invite the floor here. These are 2 very knowledgeable gentlemen, so feel free to ask any questions. Well, I don't see any hands raised.
A long day.
Yeah,
It
definitely.
won't hurt our feelings if you don't ask us.
So, Elvin, Piotr, sorry, there is one question.
Just to pick up on the succession issue, how do you deal with the lack of structure and lack of management in family-owned enterprises? How do you overcome that when you try to make them into investable companies?
Oh, it's a very painful topic. Because as I said earlier, the need is there, it is usually not recognized. So, our main job as investors is on one hand to help the company grow successfully, but on the other hand also manage the characters and the egos of the people involved, the people that have built the company and the people that are managing the company. It's a very delicate balancing act. Most of the time you don't get it right. Also because, well, you tell yourself, I invest in good companies and help to make them great. Most of the time you end up investing in companies that are missing something. Usually that something is strategic thinking. The companies have outgrown their founders or their managers, especially when they are, family and so on. Because in families you have the father that, typically the father that has established the company, the mother running the finances, and the two kids run sales respectively and manufacturing. And how do you handle that? As I said, it's very difficult, and what we do is usually, unless we buy 100%, and then we do what we want, what needs to be done, we have to take it one step at a time, increasingly, very slowly, their comfort zone. When we need to go outside the country, that means that we need to hire people. These people are not part of the family group. And that means that to them, these people, these outsiders, are mercenaries. Not just that, they also contribute actively to changing the culture of the company. That creates a lot of friction, a lot of tension, and very often you can ruin good companies if you don't handle this process well. There's no recipe, there's no formula. You kind of tend to play it by ear, depending on the characters and the egos of the people involved, including the limitations of yourself as an individual and as a professional.
Piotr, would you like to add something?
Yeah, I think we both laughed when we heard that question because we understand the inherent problems of dealing with private enterprises, private entrepreneurs, and trying to make these effectively companies digestible for investors we will speak to. And I find that's why I essentially promote what I do primarily as strategic advisory, because very often the preparatory process from the beginning of discussions until you're actually ready to go to market and try to present the company to potential investors, it can last a year, it can last a year and a half. There's usually a lot of work along the way in terms of straightening financials, straightening reporting, creating management accounts that we can use for our work, and then that we can actually present to investors and sort of not, not have to go like this when they start reading them. So it is an education process. Also, there are very often extensive discussions on valuation. Where is the market? What is reasonable? What is not reasonable? What can we do to improve things? And I think to give an example, I was selling a company 15 years ago. Oil and gas, steel manufacturing dedicated primarily to oil and gas at the time. We began a process. We sort of relied on what the management and the owners were telling us at the time about the quality of the financial statements and the balance sheet, and very close after signing of receiving an initial offer, we're going to sign a term sheet, and the owners called us for a meeting just before a meeting with a fund from Houston, or otherwise based, funded from Houston, and they're like, you know, we have to tell you something. You know, these profits that we've been making and this inventory that we have on our balance sheet, it's not real, it's not really there. So we reported profits, we put on work in progress, we put it into the balance sheet, so there are these tens of millions of work in progress, but you know what, it's composed of air, there's nothing there actually. And frankly speaking, I mean, obviously the transaction failed at the time. They recently came back and said, hey, you know, it's been 15 years, the owner changed, the management changed, but we knew each other because this was a transition process at the time. And we discussed reinitiating this transaction after 15 years and having straightened everything out, because now it's very well managed, all the financials are in order and things like that.
Did the accountant change?
No, it was even more complicated. The CFO, who was fired, actually called the fund and informed them that this work in progress was not completely, you know, reflecting the actual state of inventory in the company. So it was more, he was fired before, and that's why, you know, news travels and information travels in many unexpected ways. Nevertheless, I think one key takeaway from that situation is that transparency is very important. If you see a problem, and it's a problem you cannot resolve there and there by reporting it or reclassifying it or otherwise making it digestible, be transparent about it. The guys that were on the other side of this transaction said, hey, we won't do this deal today, but not because of this, you know, work in this inventory, misrepresented inventory. If you would have, or if we had known, and if the company would have informed them about this, we could have recalculated, re-estimated, taken into account an adjustment in the transaction value, and the deal would have gone through. But a complete loss of trust at such an early stage of an investment makes the deal just fall, and it didn't happen at the time. But yeah, I'm happy to report. I think this is the longest between such a situation. We are discussing such a transaction again after 15 years.
Thank you, Piotr. Any other questions? We have two more.
Okay, my question is to Mr. Elvin Guri. Based on common past, both countries, I mean Bulgaria and Albania, we came from socialism, and I guess that we are same age, so 90s there are the changes. And now, based on your experience, what are differences and similarities in both countries? Based on your experience here in Bulgaria and in Albania. I am not specific about exactly, exact differences, but based on your experience, the important ones.
Well, Albania was a lot less economically developed than Bulgaria in the 90s, and that lag has continued. It suffered a lot more in the aftermath of socialism than Bulgaria. Like here, but I think slightly more than here, it has not been especially lucky when it comes to politicians and generally building a democratic system. So, having said that, Albanian tourism has developed quite a bit, and the current government has managed to use to turn the exotic nature of the country and reputation of the country into an asset. We're still struggling in Bulgaria to do that, for reasons that sometimes escape me. When I'm pessimist, then I understand. It's very obvious why things are not working. But optimistically speaking, I think we have plenty of good things going for us here in Bulgaria, in this unique situation in which we can be both a Balkan country and a European Union country. We need to take advantage of that. We're not doing it as much, but we still have great opportunities there.
Thank you, Elvin. And there was one last question over there. Gentlemen, yeah, just a second.
Yes, thank you.
You have a mic.
And for the quality insights that you shared today with us. I think we can all agree that private equity, private debt, venture capital, mergers and acquisitions are off-market deals, meaning they don't necessarily get publicly and widely advertised that they exist as opportunities. And Mr. Guri, you mentioned something very interesting. If you're given as a successful fund manager, now already raised your fund going forward, but if you're given €1 billion, you still don't know how to do it and how to allocate it. And gentlemen, I'd like your perspective as well, but also you, Mr. Guri. Do you consider that asymmetry in the opportunity existence is a bottleneck why fund managers, sell-side advisors, and generally the market do not do more and more quality deals? Because frankly, it's more or less up to the principal owner, to the sell-side advisor, who they decide to advertise the opportunity to. Thank you.
Definitely. I think it's mostly impacted by the size of the economy. The private equity funds that exist in our region invest at most 15 to 25 million euros per deal. There are simply not enough companies that deserve or are investable at that range. We're still not there. We are still struggling to break the limit between small businesses becoming medium-sized businesses. And most of these businesses, again, need is there. That need is not sufficiently recognized. Our biggest competitor is not other funds. Our biggest competitor are banks. In the minds of the company owners and managers, that's where the competition is. Why should they take equity from us where they can get cheap debt from the banks? And sometimes this ends up in tragedies. They over-leverage themselves, and then they end up really needing equity. But at that point, it's a restructuring deal. That's why, per force, all of us that are active in the region keep our fund sizes small. 100, 125, 150 million. The exceptions are people like Provectus that come from Croatia that are going for 250 million euros fund. But even they, when they do this, they have to expand the region of operations so they can cover countries like Romania, where, because of the size of the economy, it's relatively easier to find. I'm not saying it's easy, it's relatively easier to find larger companies. I invested 7 years ago in a telecom operation in Albania, one of 3 telecom operators. The size at the time was around 70 million euros. 70 million euros is a decent size for a country like Bulgaria, nothing to write home about in Poland, but it is very significant in Albania. See what I mean? Even so, we couldn't find investors for the company because it was in Albania. Here, our struggle is to find enough companies that do 70 million. Does that address the question?
I guess just close this discussion. Yes, transactions that are more or less public or otherwise directed to everyone and nobody actually put the investors off. It's a bit like participation in public tenders for building bridges or something like that. There will always be somebody who will bid too low in the case of a bridge, or you expect that either somebody will bid much higher than you or not at all. There are a lot of potential competitors. Probably the deal is not directed to a specific need, and therefore I understand that from an investor's perspective there's no time, no need to commit time and effort to such a process. And that is what I have been observing thus far, that it is really important to understand the particular investment rationale from the perspective of specific investors, to narrow down the target group that you want to do perhaps some peak marketing, and then choose who you believe you will actually get the deal done with.
Thanks guys, thanks to all the people from the public that participated, Piotr, Elvin. It was a pleasure for me, from my behalf and from the behalf of the Bulgarian CFA Society. Thank you very much once more for joining.
Thank you, Nikolay. Thank you.
Thank you. And now we'll have a 10-minute coffee break. Thank you.